Good morning. It's Tuesday, the 11th of June, and this is Govindraj Ethiraj broadcasting and streaming from and headquartered in Mumbai, India's financial capital. Before we start off, are the stock markets at a crossroads once again? Well, if you think about it, the major driver for stock markets has been the general elections of 2024, for which votes were counted and results announced on the 4th of June. The Bharatiya Janata Party and the BJP had the majority of votes, though it could not form the government on its own, so it has two allies, the Janata Dal and the Telugu Desam Party. Except for the presence of the allies, this is exactly what the markets have got. Now, the markets were looking for policy continuity, and that has been secured largely. Now, this has been further helped by the fact that the key economic portfolios now announced are almost identical to the previous reign, and more on that shortly. Not surprisingly, the markets hit fresh highs in trade on Monday, and more on that shortly. This also means that the triggers will now either be global or local, of course, which the next major one is, as we mentioned earlier, the union budget next month. Till then, brace yourself for a somewhat flat run or a slow rise. Meanwhile, the top themes and stories for the day. And before we start, once again, I will be on a conference break till the end of the week and traveling, so I will not be able to do the daily report. But I will be back over the weekend with our weekend edition, and then on Tuesday, since Monday is a markets holiday. Now, the top stories and themes. The stock markets hit record highs amidst volatile trade, and a flat run is predicted ahead. Is India pulling away from the global interest rate cutting cycle, and what does that mean? Nirmala Sitharaman is the finance minister of India once again. Auto sales fall sharply in the month of May. And surprise, gold is getting more difficult to find and mine.
This is a call report with Govindraj Ethiraj.
The stock markets seek direction once again. If the markets wanted political continuity, they've got it in precise shape and form, with the key positions in the new cabinet being almost identical to what they were earlier, and more on that in a moment. On Monday, after moving up and down, the benchmark indices snapped a 3-day winning run to end lower thanks to IT, that's information technology services stocks, and stocks like HDFC, Maruti Suzuki, Bajaj Finance, and ITC. The BSE Sensex hit a record high of 77,079. Going over the 77,000 mark for the first time, the Nifty 50 touched a new peak of 23,412, going past the 23,400 mark for the first time ever. That was on Monday in trade. The indices finally closed lower. The Sensex was down 203 points at 76,490, and the Nifty was down to 23,259. Now, the broader markets were, however, higher, with the mid-cap and small-cap indices going over 0.5% and 1%, so roughly between 0.5 and 1%. Moving on from the stock markets, oil is now holding steady after falling last week as traders globally looked for fresh cues. Brent is still trading below $80 a barrel after losing about 2.5% last week. Traders will be watching for monthly reports from the OPEC, that's the Organization of Petroleum Exporting Countries, and the International Energy Agency, that's due Tuesday and Wednesday, that could provide some outlook for the rest of the year, after the OPEC recently said that it was not likely to increase production, or hinted that it may not increase production, as it earlier said only a few weeks ago. All of this according to Bloomberg. Is India pulling away from the global interest rate cut cycle? Interest rates in the financial system, that's in India, are expected to remain steady, with the Reserve Bank of India keeping the repo rate steady at 6.5% for the 8th time in a row over the weekend. The rate-setting panel of the Reserve Bank also left the monetary policy stance unchanged at what it called the withdrawal of accommodation. The Reserve Bank of India has hiked the 24-25, that's the current year GDP growth projection, to 7.2% as against 7% earlier, but left retail inflation unchanged at 4.5%. That's the forecast. Analysts were expecting GDP growth to be 6.9 to 7% for the current year. Meanwhile, Reuters is reporting that consumer inflation may have snapped a 4-month downward trend in May thanks to rapidly rising food costs, as we've been reporting here, particularly vegetable inflation, also suggesting, therefore, that the Reserve Bank of India is still several months away from cutting interest rates. Is that an issue? But we'll come to that. A Reuters poll of 50 economists conducted between 5th and 10th of June has predicted that consumer price inflation, or CPI, is expected to have picked up to about 4.9% from April's 4.8%. forecasts for the data scheduled to be released on the 12th of June or tomorrow range from between 4.3% to 5.2%. So what is the Reserve Bank of India's thinking on interest rates in the context of inflation and the overall growth environment, and how is it likely to pan out, given particularly that the European Central Bank has already cut rates and the Federal Reserve of the United States is being watched closely to see when it will follow next? I reached out to Dr. Brinda Jagirdar, senior economist, and I began by asking her how she was seeing India's interest rate moves in the context of what we were seeing globally and then in the context of growth.
The trend now seems to have moved or shifted towards a rate cut. It's only a question of when, how far, and when they will start and how long they will continue. The compulsions to move to a rate cut are very different for the Western countries when you compare it with India. Now, ECB has cut rates mainly because it needs to shore up the faltering European economy. And inflation also, they don't have much respite from inflation. At the same time, they need to shore up the economy. So therefore, they have a compulsion, in my view, to cut rates. So that's what ECB has done. And I think Canada has also done that, and maybe Australia, I'm not too sure. But the thing is that in India's case, I would not go so far as to call it decoupling, but I would just say that right now, our situation is different. Growth is holding up very well. It's 7-8% growth. So there's no compulsion to cut rates to stimulate growth. At the same time, inflation has also come down. It is well close to RBI's target, 4.5, but RBI still insists on a 4%, mainly because there are still uncertainties around inflation, whether we take global supply chains or whether we take food inflation, the monsoon. So RBI is not in such a hurry to cut rates. Like ECB has cut rates, it's going to be a very shallow cut and it's going to be a very short cycle. Now, in India's case, yes, first of all, we will need to move away from this withdrawal of accommodation. That would be the first indication. Like I said, there's no urgency really to cut rates because at the same time, there are a lot of global uncertainties which RBI has to contend with. So it will take some more time. It will be on this wait and watch mode for a while. And then perhaps by the end of the year or maybe early first quarter next year is when we would see the first rate cut from RBI.
So you mentioned that, our growth is strong. When you say growth, you're using GDP, I'm assuming, and not, let's say, gross value added. Now, is there a formula of some sort which says that, okay, if you've reached, let's say, 8% of growth, or let's say in this case, 8.2% growth as of last quarter, and therefore we don't need to cut interest rates more or we don't need to stimulate growth further?
No, I don't think there's any formula like that. But the whole thing is if you want to stimulate growth, you need to cut interest rates. That is not a compulsion right now. So growth is holding up very well. And given the traction for manufacturing, infrastructure, reforms, so all this is going to take growth forward. So we don't need that push from the rate cut to keep the growth momentum going. That's so far as growth is concerned. And when it comes to inflation, because that's what the Reserve Bank is watching more closely. Like I said, it has come down. Inflation has come down. CPI inflation has come down. And it is expected to be even lower in May, but by July, August, there would be a slight hike and the later half of the year. And again, it will settle down by about 4.5% by the time the year ends. So inflation is not such a big concern looking at our domestic movement right now. But let's not forget that food inflation is still high and it could spread into general expectation and then the CPI. And we don't know how the monsoons are going to pan out. And at the same time, the geopolitical situation needs to be watched closely. What happens to our supply chain? Because now we are getting more and more dependent on the global supply chain so far as manufacturing is concerned, whether it's electronics, whether it's defense, whether it's manufacturing, any manufacturing. So any disruption in trade, supply routes, availability, all this could affect us and then increase inflation. So I think that's where the Reserve Bank is going to be a little watchful.
So you're saying that in your understanding, rates are being held high at this point, mostly to tackle inflation, and you feel the correlation is more direct there?
Yes, inflation. And like I said, we cannot ignore the global situation. So on both these counts, the Reserve Bank is holding rates and seeing how the situation, because it wants to move to a more sustainable area, not any sharp swings here and there. So it wants to make sure that the situation is more stable, more sustained, and then the Reserve Bank will go ahead with a rate cut. Because right now there seems to be limited clarity on what the future will look like.
Right. And the repo rate is at 6.5%. What's your sense on transmission? At a retail level, or at what time do you feel people could start seeing any shifts in, let's say, the cost of their home loans or retail loans and so on?
The home loan, retail loan will get cut only when the interest rate gets cut. But at the same time, now I think there is one positive sign that I see in the policy. The credit, which Reserve Bank governor talked about, the credit growth is holding up very well, but deposit growth is lagging. So banks need to really scramble for deposits. And that's where I think we will see them offering better rates, and that will be good for the depositors.
Since you mentioned that, how do you see that challenge today? I mean, a lot of banks are talking about it. Investors in bank stocks are asking about it, as to how banks are going to grow their deposits, which they need to obviously lend, and they need to borrow at lower costs so as to lend at higher levels.
You're right, absolutely, because banks are not only looking to raise more deposits to fund the growth, they're also in a race to raise capital, because that's what is needed to be able to sustain this level of growth and credit. So this is going to be a challenge for sure, definitely. And that's why the markets are being closely watched. And perhaps when the dust settles, we will see new investors coming into the market. The Indian market is still attractive, let's not forget. So that is probably what will help to remove the froth and remove the heat, prevent the system from heating up. But yes, I think they will have to really offer, better rates to depositors. Maybe they'll come up with, say, 500 days or 400 days, whatever, to make sure that their deposit base is not eroded, because that's the only way they can continue to lend and to meet the credit demand which is there in the economy.
Right. Brinda, thank you so much for joining me.
Thank you, Govind.
India's next finance minister is Nirmala Sitharaman. The government is betting on continuity on the economic front, at least now, with key portfolios unchanged in the new government. Now, this will come as a relief to businesses and markets, particularly those who are worried about any dilution thanks to the presence of allies. The current lineup would suggest that there is absolutely no change, and life for those seeking so can return to normal. Nirmala Sitharaman is the next finance minister. Nitin Gadkari is continuing with roads and transport. Amit Shah with home, that's the home affairs. Piyush Goyal with commerce, Rajnath Singh with defense, and Hardeep Singh Puri with petroleum and natural gas or energy. For those asking, once again, there could not be a better demonstration of continuity. And yes, S. Jaishankar gets external affairs, so all is steady on the home as well as external fronts. Railways and information broadcasting goes to Ashwini Vaishnav, so broadly the same again. Auto sales fall sharply in May. The new ministers, economic and otherwise, will have to deal with economic challenges apart from climate, which is affecting the economy. So will this new deck of ministers, which is the same as the last deck or the previous deck of ministers, deliver? Retail sales of cars in India fell 1% in May, tracking slowing wholesale growth as elections and extreme heat across the country dampened demand and delayed purchase decisions, Reuters quoted the Federation of Automotive Dealers Association saying. Extreme heat conditions dissuaded customers from visiting showrooms, with walk-ins dropping by about 18%, according to FADA President Manish Raj Singhania. FADA, or FADA, has been struggling with high inventories at its dealerships in recent months, as told to the core report earlier as well. Sales growth in two-wheelers slowed to 2.6% in May from 33% in April, said FADA. Overall retail sales across segments, which include two-wheelers and commercial vehicles, grew 2.6% in May, compared with a 27% rise in April. India's auto industry represents 7% of the country's GDP, and auto sales are quite obviously a good indicator of private consumption. Overall, the markets continue to grow and are at record levels across segments, particularly passenger vehicles and within that, SUVs. Gold is getting harder to find. Who would have thought? After reports yesterday that China was slowing down gold purchases following high prices, it's now emerging that the gold mining industry is struggling to sustain production growth as deposits of the yellow metal becoming harder to find, according to the World Gold Council. CNBC quoted data from the World Gold Council, or WGC, saying mine production was up only 0.5% in 23 compared to a year before. WGC, or World Gold Council Chief Market Strategist John Reed, said in a report quoted on CNBC that they had seen record first quarter mine production in 24 that was up 4% year on year. But the big picture was that effectively it was plateauing around 2016 and 2018, and there has been no growth since then. According to the chief market strategist, he said that the overwhelming story was that after 10 years of rapid growth from around 2008, the mining industry is struggling to report sustained growth in production. And the reason for this is new gold deposits are becoming harder to find around the world as many prospective areas have already been explored. Large-scale gold mining is capital-intensive, requires significant exploration and development, and it takes about 10 to 20 years before a mine is ready for production. Even during the exploration process, the likelihood of a discovery progressing into the development of a mine is now low, with only about 10% of global gold discoveries containing sufficient metal to warrant mining. So the big number is about 187,000 tons of gold has been mined to date, with the majority coming from China, South Africa, and Australia. And gold reserves that can be excavated are estimated at around 57,000 tons, according to the United States Geological Survey, quoted once again here by CNBC. So the interesting thing, as I can see, very, very roughly speaking, is that only about 25% of the gold existing in the world that's been mined already is still to be mined. Apart from the discovery process, WGC says that government permits are getting harder to secure, taking more time to come through, and that all makes mining more difficult. That includes the license and permits that you need, which can take several years. Moreover, many mining projects are planned for remote areas that require infrastructure such as roads, power, and water, all of which add to costs and time. So the bottom line is it's getting harder to find gold, permit it, finance it, and operate it, according to the WGC. So coming back to prices, they're at this point taking a pause after rallying to record highs in recent months. Spot gold is currently around $2,294 per ounce. It'll, of course, be interesting to see how gold demand pans out from here on and whether prices rise, as has been projected by several analysts, including on the core report. That was the core report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.